Okay, everybody, let's start today's webinar. Hello, welcome to this webinar. How are you? Hope everyone's fine. Hello, Alinda and Annie. As you may know, we are starting this Beginner's Corner series of webinars on Friday afternoons, not only to tip-tap the beginners in the Forex market only, but also to share with you some of my personal experience with each technical indicator, some things that search for empirical observation, and some tips and tricks you may not find in books, right? Today we are going to talk a bit about CCI, or Commodity Channel Index, and the different ways to trade it and how to understand the indicator. But before starting about the indicator, maybe it's a good idea to remember a bit some basic concepts regarding Forex market, right? Anyway, keep in mind that I will be talking about 20-25 minutes, and after that you may be able to ask any question you want regarding this subject or any other technical subject in the Forex market. I will try to answer all questions, okay? So, as I was saying, there are some concepts we need to refresh, right? You know that our main objective here is to take the maximum advantage possible of price rallies, right? And reduce to the minimum the losses. That's our main target always, right? Being so simple said, the fact is that it's not as easy as it seems when we have to do it in the real life and in our charts, right? Nevertheless, the theory of the cycles and the analysis of price action of following this kind of cycle indicators, right, tend to identify those movements in the market, probable tops, probable bottoms, probable exhaustion conditions, and may help us to make that task of forecasting the market a bit more easy. So let's start by reminding what is a cycle, right? A cycle is the process of evolution of the price curve and respond to a natural logic of evolution in an associated involution. The main thing that I believe that we all do and we all need to be aware of is that when we do technical analysis, we tend to focus in the price action, right? We tend to follow price with a price, and we usually forget the other axis of the graph, that is time, right? And that's the whole idea of simple indicators. They will help us to include or understand the temporary space where the price movements may happen, right? And that will help us make a more accurate trading decision. So that is why it's so important to understand what a cycle is and never forget about the time axis in our charts, right? So, starting with the Commodity Channel Index, or the CCI itself, it's an indicator developed by Donald Lambert, right, and consists of the difference between the mean price of a current pair and the average price of that mean price over a certain period of time, right? So, while higher values in the indicators shows price may be unusually high compared to its average price, lower readings show us price is unusually low, right? So if we are unusually high or unusually low, there's a good chance, right, that the price action will tend to correct, right, those extremes. And that is what we use these indicators for, okay? The CCI, as you may see in this formula, is calculated as the difference between that typical price, the same that we use for pivot points, right? High, low, and close divided by 3, okay, of a commodity or a certain currency pair, and it's simple moving average divided by the mean absolute deviation of the typical price. The index is usually scaled by an inverse factor of 0.015 that help us get more accurate numbers when we read it, right? That's just an information, not something we need to actually know and understand. Well, as you may see, right, this is the formula of this Commodity Channel Index, where PT, right, is typical price, right, is the average price. And the simple moving average in here is the average of that typical price, and it's the mean absolute deviation, sorry. Okay? For scalping purposes, in the beginning, Lambert has set the constant at 0.015 to be sure that approximately in between 70 and 80% of the time, the CCI values would fall between less 100 and plus 100, right? We know that this is an indicator that tends to hover around the zero line, right? With in between less 100 and plus 100, right? So the idea is that that constant Lambert added makes price stays in between those two levels in around the 70 or 80% of the time, right? So when the CCI fluctuates above and below that zero line, as long as in between those two extremes, right, we may have a bullish or bearish trend when we are not having too much of a signal or too much of a good swing, right? Of course, if we change the average of the CCI, it comes back like in 20 periods, like almost any other technical indicator, right? If we change the number of periods, we will get different readings, right? So a shorter commodity channel index, let's say 10 periods. I never tend to use indicators in less than 10 periods, okay? 10 should be the less, and even better 13 because it's the Fibonacci number. That will be the best one to choose if you want to a faster indicator, right? So if we reduce the number of periods in our formula, that will make the indicator more volatile, right? While with a smaller percentage of values between plus 100 and less 100, right? The number of values that will be trapped will not be 70 to 80%, but probably around 50%, right? And on the contrary, right, if we increase the period under analysis of the simple moving average and the average and the typical price to anything above 50, right, now the higher percentage of values will be between that plus 100 and less 100. I will say that above 90%, right? So that means shorter CCI give us more signals, larger CCI will give us less signal. Whether those signals are accurate or not will depend on the charts and the studies and the previous backtesting we have done about. Okay? But keep that in mind. Shorter indicator is usually faster and give us more signals, but tend to be less reliable usually, unless you work with bigger time frames, right? You cannot use shorter indicators in 1 hour or smaller time frames. I would say that 4 hours charts is the minimum where you can locate a shorter indicator, right? But if you want to work with 10 or 13, as I said, daily chart, weekly chart could be great, right? We'll give accurate signals. But if you want to trade in a shorter time frame, like, I don't know, 1 hour, 30 minutes, or 50 minutes, maybe it would be a bit more wise if instead of using the 20 simple moving average to calculate the commodity channel index, you use, I don't know, maybe 50 time periods. I would say that 100 is way too much. 50 seems good enough. I have developed a trading strategy long ago with a 50 commodity channel index that seems pretty interesting for euro dollar. Anyway, back to the basics of this, right? We usually said, as a general rule, right, we are going to see examples, right, that we have buying or selling signals when the indicator, in different cases. The first one is when the indicator crosses the zero line, right? If it crosses downside up, we have buying signal. If it crosses upside down, we have a selling one, right? Also, we say that we have buying or selling signals when the indicator crosses those extreme 100 and less 100 lines. We are going to see that in more detail right now, okay? We also have or may found technical divergences in the indicator, right? Or we can also see signs coming from trend lines draw inside the indicator. But what I consider the most important one and the one that's most reliable and I tend to use a lot in my daily trading is to see B patterns outside extremes when re-entering. Those tend to be the most accurate trading signals we have with the indicator. Okay. Anyway, don't worry. We're going to see examples of every of these cases slowly and with patience. It's just a general introduction. Okay. And on the contrary, you will have to close our trade, no matter if we're winning or winning one or losing two. Right. We have to close our trades when the indicator crosses the line in the opposite direction of our trade. Right. If we are bullish and the commodity channel index crosses the midline, the zero line, upside down, that is advancing after the market will turn probably bearish. So if we are bullish, we need to close our trade. okay? And we also need to close our trade when indicator turns flat. Why? Because it's pointing for a consolidated stage. When indicator is flat, because price action has spent at least the past 10 candles trapped in range, meaning there is no return. There is no bullish, no bearish, no nothing in the market. The market is ranging, right? And we know that after such ranging and after such long time being inside the market, starting trade, right? And the time exceeds the limit of a logical trade, right? Indicator is flat. Anything could happen, right? So no matter if we're losing or winning one pick, we need to close that trade also. Okay? Also, if we have trend lines draw inside the indicator, right? And that trend line is broken in the opposite direction of our trade, again, it's a warning to close our trade. Most of the times this tends to happen when we are already winning, right? So it's not a big deal. Just our warnings of what could happen, how the market may reverse, and it's telling us a tip to start taking advantage of the gains we already have and don't risk them too much. From the books, it says that we have to close our trades when we break the 200 or less 200 extremes. You know that despite we mentioned that the indicator works in a 100 less 100 area, those values also can be adjusted, right? 50, 150, 200, whatever you want. I usually change them to 200 or add a 200, 200 less, both levels, because of I believe that it depends of the intraday range of the pair and the value, right? For example, dollar Japanese yen, when the Bank of Japan is not intervening in the market, usually it has been moving this year, I don't know, less than 80 pips per day, okay? So we will hardly see the commodity channel indexes reaching the 100 levels, okay? But in crosses like pound dollar or pound yen, when we have 200 pips average day, right, we have a wider intraday range, the currency pair could push the commodity channel index to reach the 200 or less 200 areas pretty easily, right? Because we have a wider range, trading range, right? In fact, and despite what the book says, the break of the 200 or plus 200 extremes could mean top or bottom is near. The fact is that I don't follow that rule strictly, particularly as I was saying for pound dollars. Okay? And of course, we have to close our trade when the indicator change the range against our trade. Okay? If the indicator is going upside, to the upside, and we are bullish, and the indicator turn bearish, well, it's the first warning that we make how to take profits and forget about that trade for good, right? Anyway, keep in mind that it's always important to draw trend lines, right? Inside the indicator, not in the chart, right? But inside the indicator, okay? And pay attention if they are broken either our side or contrary side. Those are also understood as trading signals and not only applicable for CCI, okay? And also, another thing that is pretty important, and it's more easy to see in indicators such as the commodity index, and of course, they don't exist in indicators such as MACD, are the figures, the chartistic figures like head and shoulders, double roofs, double bottoms, triple roofs, triple bottoms. Those kind of figures can also be seen inside the indicator, right? And they tend to give a very good result, as well as if they do in price action and in candles. It works inside the indicator. Another thing that is important that I would like to share right now before I forget is that sometimes, just sometimes, the indicator tends to make a figure like a cup with a handle or a hook, right? That handle or hook, it's in fact a pullback, right, to the breaking zone usually, okay? So this is a very reliable sign. When the indicator completes a pullback to the broken level and continues in our direction, that's a good sign that we are in the right side of the market, okay? Usually we said, we are going to see different examples of what we have discussed in some charts, and then we are going to see some charts made, okay? As you may see in this particular example, this particular chart, sorry, I was not able to find my mouse. There it is. We have sort of head and shoulders, but honestly, I won't be paying too much attention to the head and shoulders pattern, rather to the ascent and trend line that forms the neck, right? That works as support line, okay? The indicator has a support line, and we see that the moment the indicator breaks below the trend line, right? It's also breaking the zero level from upside down, right? It's giving us an entry signal, okay? As you may see, and something that I did not tell you, usually a break of the 100 level, as we are seeing here, it only means an acceleration of price action to the right, okay? It does not mean that we are reaching extreme oversold over both conditions. That's why we better or rather apply 200 levels to talk about extreme over both conditions and start talking about the end of the cycle, right? The break of the 100 line, right? It just means a price acceleration, just like in this example, okay? So until the indicator continues moving lower, right? We may stay inside the market and gain some pips extra. When the indicator starts turning flat, like in this particular case, the fact is that it's telling us that that strength that we are seeing in price action, it's getting exhausted. It may resume, yeah, it may resume, but it may also turn against us, like in this case. So, if you are trading, right, an indicator is such vertical, like in this particular case, as long as it remains vertical, well, you're in the right side of the market. When the indicator turns flat, right, that's telling you to, okay, take your profits and look for another trade, okay? This is just one example. We are going to see another one, right? And in this particular case, we are seeing what we call a divergence, right, in between price action and the indicator. Okay, as you see, daily pound is making lower lows, right, in daily basis, right, while the indicator is making higher highs, right? So when do I decide to take my entry point? Where do I take my entry point? When the indicator crosses less 100 level. Re-entering the less 100 level or the 100 are usually understood as selling or buying signals, right? We have said that. So how do I trade it? An indicator crosses, okay, the indicator should be applied to the opening. In that case, a candle opening will tell me whether it is the moment buy or sell, right? The indicator is applied to the opening. A new candle opening will mean get into the market because the indicator will cross the line, right? And that's where I take my entry with the daily opening. Where do I place my stop? As usual, the stop is something that depends of the chart you're trading. If you're trading a daily chart, like in this particular case, you cannot use a 10-20 pip stop loss. It's pretty logical, right? You have to consider the daily average of the pair and the study. In this case, the pound daily average is 150 pips, right? So a minimum stop loss should be of around 80 pips, right? 50% of the daily average. Okay, but I usually take a look at the charts, historical data, look for recent lows, like in this particular case. My stop loss a couple of pips below plus spread. That's what I tend to do. Besides, we know that once we get an entry signal, no matter what strategy or technical indicator we are using, it should be complete, or the target should be reached, right, in an average of 4 candles. Some say 3, some say 5, let's say 4. As you may see here, we have 1, 2, 3, 4 candles to reach the maximum level, right? And we are ready to leave the market afterwards. As you can see, after that 4th candle, the indicator has turned, even the 3rd one has turned flat, telling me that this level is the zone to leave the market. As you may see, the trade in this particular case has gave over 250 pips compared to 80 pips plus spread stops. It's pretty interesting, right? It's a good risk-reward ratio, okay? Anyway, here is another example of technical divergences seen in the same pound-dollar daily chart. and with the commodity channel index, okay? In this particular case, again, right, we have a technical divergence in the indicator, and my entry point is this vertical cut with zero line. The first case we have mentioned when we talk about buying or selling signals. Again, to set a logical stop loss, I will be looking for recent highs or lows, right, and place my stop just some pips above plus spread, okay? This is the case I was telling you about the cap or the pullback, okay? As you may see, we have a technical divergence, right? We have a break of the zero level that is giving us the selling sign in this particular small black candle before the one circle, okay? We have a positive one when we see the indicator completing a pullback to the zero level and then resuming its bearish trend, okay? So that sort of pullback, if we accompany it with a trend line, tends to give us better and accurate signals. Again, if you take a look at this chart, we have break the 100 line right in between this and this candle, in between these two, okay? And as you may see, we have a strong price acceleration, right, once we break the 100 level, okay? So keep that in mind. Below 100 or above 100, it's not that the trade is exhausted, but on the contrary, that we may see a continuation until the indicator finally gets exhausted. However, keep in mind that this small B shape we are seeing in here, right, is not a valid buying signal, okay? It's not that we should buy the cross. We could not buy the cross until it re-enters the 100 area in this particular candle. You see, we gained some pips in this case, but the market quickly reversed the indicator, quickly turned to the other side, so that was not a good trade, okay? It's easy to say, yes, you're following it. And another case I mentioned to you, drawing trend lines inside the indicator, right? We have, in this particular case, kind of a signal and a confirmation, right? The first one is the signal that's showing us pair breaking the trend line, and we finally break the 100 level, while price makes some sort of pullback to the trend, okay? Again, we have a player selling signal, and further falls will be expected as long as the indicator heads south. I believe that, okay, we have another example, and in this particular case, is yet again a divergence. We have the indicator finding support at the zero level, right? That is pretty important. But while at the same time, we have extended price ascendant lows in price action, right? So despite it's not so common to see, it's also considered a technical divergence that should support further rises in the cross. As you may see, the rise started once this candle, the long one, broke the 100 level to the upside, and until we find the top where the pair finally rests and begins a bearish corrective movement, okay? This is what I was saying also about the B shape that I mentioned to you. I tend to look for those B shapes, right? Either bullish ones or bearish ones around the 200 levels, okay? It's not the same to see the pair reaching an exhaustion condition in a way sort of this one, a bottom in this shape that's not a B and it's mostly flat, and when we have an accurate B. Usually in the forward charts for pound dollar, this is one of the most accurate signals you have to determine a top or bottom in the cross. There's a good chance that when you have that B signal, mostly if it favors the dominant trend when we have one, right, the price will start at least a strong corrective movement. Won't say a trend change, but at least a big corrective movement against previous movement, right? Keep in mind, however, that what's important is to have those V shapes, right, re-entering the 200 level, okay? We have the B outside the 200 area, okay, and the indicator re-entering it has given us the buying signal, okay? Once the indicator reaches the top, we may see a corrective movement in the case we have 3 days to downside. So It's sort of an interesting correction, right? It's not going to give us 20 or 30 pips. We're going to trade in the daily chart, and the price will reverse. Usually, and despite some, you should be aware that we are talking about corrections, right? The fact is that we may accomplish a good number of pips in a pretty short time, right? And as I was saying, when you have signals, right, that favor the dominant trend in this particular chart, bullish one, you may see that the results are much more interesting, right, and the number of pips accomplishing farther much more than the case of corrective movements against dominant trends. That not only applies to this indicator, and the fact is that that's the theory that applies to every single technical indicator, right? We can read signals favoring the trend, we can read signals against the trend, but we could not expect, okay, signals in both directions to give the same number of pips, right? When we are trading against the dominant trend, we may grab a good number of pips, but of course it will be probably 1/3 of what we can get if we catch the signal that favors the dominant trend, okay? Another example that I believe that I copied this is the fact that the indicator crosses the zero line, right? As we discussed, the fact of crossing the zero line is the main target. Why? The main signal, sorry. Why? Because the zero line is the one that supposedly divides the bullish market from the bearish market. If the indicator is below the zero line, market will probably be bearish, okay? When the indicator, on the contrary, is above the zero line, market is bullish, okay? So that's why the cross of that 100 level, it's zero level, sorry, not 100, my mistake, sorry. The cross of the zero level is pretty important. And as I told you, when we have pullbacks, it's even better, okay? Here's another example of a trend line. And I believe that's the end of the presentation. Then we are going to take a look at the live chart, the pound dollar for our charts of the commodity channel index, a bit more live and a bit less theoretical examples. Okay, as I was saying to you, what's important is to take the signals favoring the dominant trend. And here are a lot of good examples about that. As you may see, in this particular case, we have a V-shape bearish in the 200, less 200 level, and we have a strong bullish rally of over 450 pips, right, to the upside. Once the pair topped above the 200 level, right, where we may be finding a strong, an extreme, right, and over both conditions in this particular case, it's true, we have a bearish corrective movement. That is around 1/3 of what we get trading to the upside, and it's only giving 180 pips, okay? Same happens here. We have a big corrective movement on the pair tops, but the fact is that we only get 70 or 80 pips in the contrary direction of the dominant trend. Be aware of that always when it's trading to the market, when trading in the VL charts, okay? I will try to look for older examples. Okay, in here we have a dominant bearish trend, right? As you may see, we have the V shape and some consolidation and some bullish corrective movement. Yet, keep in mind that when we are trading against the trend, that's not with the same number of pips we can get. In this particular case, right, we have a strong bullish run that pushes across quickly to above 200 in just one candle. It's not that it's going to give us a lot of trading chances to the upside, right? But as soon as we overcome 200, we have a V shape and the indicator re-entering the 200 level in the second candle after the spike, right? And to the dominant bearish trend, we can take a bearish trade in this particular case because we have reached a bottom and jumped into the dominant trend. I always said when we're in the middle of the trend, right? We see a bearish trend. Is that moment itself? No. honestly, it's not always the moment to trade. It's not always the time to trade. We need to wait for a retracement, a pullback, a corrective movement. Okay, try to see if we can catch that fall from higher zone, right? And this indicator will be maybe the most accurate to do so. Okay, to see how much the pair could rise against the dominant trend. Okay, and give the selling opportunity. Maybe not at this stops around 165. And we can get into the market around 64.40, which is not bad at all. Okay, keep that in mind. As you may see, we have several buying signals with the V shape and the candle one indicator crossing the 200 level again to the upside and give us an entry point. But if you take a look at this, all these cases we have in pound, you will notice that against dominant trend, the number of pips accomplished is always a bit less than 100. Average, I would say 80 pips. This is an indicator I use a lot for trading pound dollar. Okay, I always keep in mind that an indicator breaks the 100 level to the upside or the less 100 level to the downside. Well, that would probably mean a trend continuation. Yet, on contrary, when we break the 200 to the upside or the less 200 to the downside, that will probably mean we are going to do some exhaustion, at least some consolidation, and that's my time to leave the trade. Okay? Okay, let me show you a little example. Okay? Okay, here we go. We are in a 20 periods now, right? If I change the indicator to 10 periods, okay, I will be seeing a more volatility indicator, right? And I will get much more signals or much more approaches to the 200 area. And if I use the 21, right, it's a bit more volatile. So it will give you more trading signals or more reaches of extremes, right, of the 200 or the 100 area. The fact is that whether those signals are more or less valid than using the 21, that's something you have to backtest in your own charts, okay? But that's the idea. The short-term indicator will be more volatile and give us more trading signals. That's it. Now, there's so much to that, okay? This is my daily chart, okay? This is the one I use on a daily basis to trade with the commodity index, trade dollar pound. And as you see in this particular case, right, the fact is that when we have the break of the 200 extreme, okay, at the same time we have an increasing momentum and the candle breaking, above the momentum was not in extreme overbought condition, but in fact we were going even a buying signal, right? So I not only buy but stayed inside the trade, right, until momentum starts to bend lower and get exhausted and get flat, right? That's why, despite sometimes we may see, okay, we are in extreme overbought conditions, okay, the fact is that we are not, because momentum is giving me a buying signal in that particular moment. The trend was favoring also the trade, right? So that's one example of that. On the contrary, let's see another example, right? In here, we have a buying signal, but momentum was a bit exhausted to the upside. And as you may see, I did not take this particular one, okay? Because despite it moves upward some pips, the fact is that the momentum was heading lower. So it was telling me, okay, not the right time to buy in this particular one, okay? Maybe I missed some pips, but the fact is that since then the pair has been mostly range bound and with lack of definition. Fact is that no matter what system or strategy or indicator or whatever you use to trade, you have to learn to read what you're seeing, right? It's not like you just sit and judge in front of your chart and say, okay, this is going higher, this is going lower. Maybe not in this particular case, both should be up. And then say, I buy. No, it's understanding the position of the indicator to its relative ratings, right, which is the most important thing we can do with this indicator, and try to filter one with each other, right? So that's why I use the T-class one to tell me if we are near extreme of the sold or both conditions, and a momentum or a trend one that's telling me how strong the trend we are seeing in the market is. okay, or how exhausted it will be also. Because momentum is also showing you when it gets exhausted, right? When it starts to turn flat or bending in the opposite direction. Okay? So that's why I tend to filter these two one with each other. Ropal says, how do you analyze the euro dollar? In the same way, but instead of using the commodity channel index, I tend to add a relative strength index because I find it good enough to tell me we are in oversold or overbought condition. What I believe at this point is that we are not going to rise too much more from here today. The market is almost done, but having bounced so strongly from the 40-50 bottom, we could expect further range and maybe a 43, 44 for next week. Okay, then, in this case, I will, yes, finally say goodbye. Sorry for the previous one. Thanks all for being here, and hope you enjoyed the webinar. It's being recorded, so you can find it back in the Exhaustion.com education section. Okay, I'll see you back on Sunday. Have a great weekend, you too. Thanks all for being here. Bye-bye.